Nvidia stock has been trending down ever since reporting earnings, and right now we continue to see massive bearish thesis coming out for Nvidia stock. A good friend of mine actually posted on X and asked, what are some of the bearish theses that you believe are true for Nvidia? And he got a lot of comments. And on today's episode, what I'm going to do is I'm going to go through these comments and try to debunk all the bearish cases out there. And it's not just going to be with what ifs or just imaginary cases. We're going to look at actual data driven information that can put a lot of these bearish theses to rest. Now, while I am an Nvidia shareholder, I do believe that there are bearish cases. And I'm actually going to share what I believe are the biggest bearish thoughts for Nvidia. And to my surprise, none of them were mentioned during this post. So let's take a closer look in today's episode.
I want to thank The Motley Fool for sponsoring this video, and check out fool.com/Jose for the 10 best stocks to buy now. With that link, you get a promotional offer for the subscription service. Now, let's continue with today's episode.
So welcome to the channel. For those that are not familiar, my name is Jose Najarro. I am a semiconductor investor, 33. My birthday today just turned 33. I've been following the semiconductor industry for a very, very long time. I come with a master's degree in electrical engineering, and most of my portfolio is based on the semiconductor industry and the technology it hits. So I am a huge Nvidia bull, but today we're going to look at the bearish thesis, and I will also, like I mentioned, share some real thoughts on what I believe could be some of the things that will impact Nvidia in the long term of things. But the first bearish case that we see is the what if bear case, right? So we can see from this post right here that Nvidia, on the other hand, is riding a massive AI capex wave right now. Pretty much the bear case is simple. What if the AI build out doesn't scale as expected? Now, unfortunately, from forms of data, all these big cloud service providers have increased capital expenditure and are increasing it for next year as well. But if you're going to give me a what if, I'm going to give you back a what if as well. What if AI completely changes the robotics market, the autonomous vehicle market, the healthcare industry, the AI agent, every other industry? What if AI creates a whole new AI market and AI new product? We can see with this what if case, Nvidia has actually showcased that the healthcare market is potentially a $100 billion AI factory opportunity, where in fiscal year of 2026, this is only a little bit over a $1 billion on an annual recurring basis. So what if this slideshow that Nvidia presented is true? And what if the healthcare market alone is over a $100 billion annual recurring revenue? So for the what if bear case, what if the AI build out doesn't scale out as expected? What if all these market opportunities come through? Now, the next case is the Cisco case. So I sell options guys here. What is the upside from here? A double? What is the downside? 90%, maybe 95%. It's not about failing. It's more about understanding that cycles, while they don't repeat, they rhyme. And I agree with that. I agree that there are cycles, right? There's going to be a form of over investment in certain AI solutions, which creates some form of over inventory correction. But I do want to say this bearish thesis lost me at downside of 90 to 95%. Also, when is double a bad thing, especially if a company doubles in 5 years? That is still better than the market, right? The market typically tends to double in every 7 years. I don't believe the downside is necessarily 90 to 95%. And I do believe the upside is definitely at least a double from here if we get those market opportunities. But here is the Cisco case, right? Cisco versus Nvidia. Cisco products were not helping companies grow revenue directly or earnings like Nvidia. We see Meta platforms growing their advertisement solutions and ad money thanks to AI solutions from Nvidia. We see the big cloud service providers grow their cloud business dramatically because of Nvidia solutions. So they are actually seeing results of the numbers. Nvidia's demand is led by hyperscalers and large platforms funding AI to drive ads, cloud services, and productivity. So you're getting a return on investment already. Cisco products were not giving customers an ROI already. Cisco also sold an excellent networking hardware, but didn't control kind of the compute software platform used by millions of developers. Nvidia, on the other hand, has a complete ecosystem from hardware, from software, from the developers that generate AI applications, AI solutions in that system. That makes it a lot more stickier than Cisco was in 2020, in the 2000s. Cisco's 2000 valuation was mainly on expectations driven. Nvidia's surge has been driven by earnings per share growth, not just revenue growth. And we will see some charts in another slideshow as well. Also, companies are already being reserved on capex. In theory, if they invested more, and if you kind of look at all the cloud service providers' earnings transcript, if they invested more, they could have grown their cloud service business even more. They choose not to. So right now, we can see them themselves, even with this massive growth, are still being reserved. That's controlling a little bit of the over inventory reactions. Nvidia also has limited manufacturing, preventing, again, another massive inventory correction. I believe this is a case of a potential bearish case, but there are reasons why this cycle can last a little bit longer. Nvidia's annual cadence also allows company to continue to reinvest. Nvidia personally tells their customers not to invest all at once since a better chip is coming next year. We also have the supply constraint or the power constraint of data center real estate and power limits, which do limit over orders. No one wants to have their chips sitting idle. So right now we are already seeing a way that over inventory is being kind of protected a little bit. It's not an absolute protection, but there are many reasons why over inventory is not a massive bearish case yet. Now, we also have a high multiple case. As soon as the slowdown in the AI market comes, the growth rate won't justify these multiples anymore. How crazy are the multiples for Nvidia? Let's kind of take a closer look. So trailing 12 months PE ratio is 50. That seems pretty high. Next 12 months PE ratio is 30. How much does earnings need to grow to get 30 in the next 12 months? You should see about a 40% growth in earnings per share to kind of get that next 12 months PE ratio of 30. Is that impossible? At least for this year, I don't think so. 40% earnings per share expected in the next 12 months. In this quarter alone, the company grew 54%. Even if you start to see year over year the acceleration in earnings per share growth, I do believe we can still expect 40% for the next 12 months. So now we found out that it's not impossible to grow to its next 12 months PE ratio of 30. Now from there on, even if instead of growing 40% in the next 12 months, it only grows high single digits, you still get high 20s PE ratio for the year after that. So valuation, in theory, doesn't seem that crazy, right? Expectations 40% this year. And even if you grow single digits next year, you're still in a forward PE ratio of high 20s. There's a lot of other companies trading at crazier valuations. And I do believe within the next 2 years and 3 years, earnings per share will still grow in the double digits, even if it's in the teens. So PE ratios and all these metrics can continue to contract into smaller and smaller precision. So for me, I don't think multiples are that crazy and expectations are that high. Like I mentioned, this year seems crazy, but even after that, you give a minimal growth on the company, valuations are still pretty impressive in my opinion. Now there's this one, right? The only few customer case. Someone wants to talk about how there's not that many companies that are buying Nvidia. There's only about 2 or 3 customers that represent majority of the revenue. I agree that a small number of customers at a top level seem bad, but the next image that I'm going to show you is why it's not exactly what it seems. This user also mentioned that DeepSeek is not a threat to CapEx. It's an acceleration to CapEx, as you can do more inference and more thinking and make more models, so the demand will grow over time. When DeepSeek came out, we saw a huge influx of AI demand, and it actually accelerated the overall AI ecosystem. Every company spent more money after DeepSeek. I don't think DeepSeek should be in the bearish thoughts right now. But in terms of the few customers, most people only look at step 2 and step 1. Nvidia and the selected three customers, AWS, Azure, and Google Cloud. But what people forget is the reason these companies are ordering is because they have a great visibility of these enterprises and startups that are requesting AI solutions. So it's these are the middleman, but the real demand for NVIDIA's solutions are coming from thousands and thousands and thousands of customers. So is it really a selected few, or is it that a selected few are collecting that chips to be able to support the massive amount of customers that want NVIDIA's products? Next is the TCO, total cost of ownership. And total cost of ownership is important, right? Kind of running a data center, you need to make sure that you're running it at the most efficient rates. But for TCO, that was the topic a few years ago. Now it's all about revenue making as well. It's not just TCO. You need to have these data centers make plenty of revenue and make plenty of money, because if they are generating revenue for you, you can kind of bring that revenue growth to your overall top line number as a cloud service provider. The other thing is NVIDIA has a massive moat in TCO thanks to their ability to interconnect data centers, chips, and various networking solutions. That is crucial for the TCO of inference and training. We can see here for their NVL72, the Blackwell Ultra, the ability to connect 72 GPUs together increases TCO dramatically. It also increases revenue making dramatically. There is this slideshow here and information from Morgan Stanley that showcases that NVIDIA's solution, while it might be a little bit more expensive in TCO, you do get a lot more profits coming in, which make this the better sense for companies to develop using NVIDIA's solution. Now, there is also this thought. So Research and Invest didn't come up with it, but it seems like someone had a wrong analysis on declining data center sales. Data center market is slowing down. Not necessarily. I mean, we can still see data center was up on a sequential basis, even though the China market is seeing major headwinds due to restrictions. North America, or United States alone, still grew by nearly $3 billion in revenue. So even with the decline in China, data center revenue still went up. What happens when this market opens back up for NVIDIA? We will continue to see a nice acceleration in data center market. This is also another one, China versus Taiwan. Many say that this is one of the largest risks, which has nothing to do with the balance sheet, with the strength of NVIDIA, is what happens if China invades Taiwan? And I want to say this is a real threat, but I don't think it's fair to put it as an NVIDIA only threat. I mean, here are the top S&P 500 index components. You have NVIDIA, Microsoft, Apple, Amazon, Meta, and Broadcom. If there is an invasion of Taiwan from China, how will Apple sell iPhones without TSMC? How will PCs for Microsoft be made? How will PCs from any other companies, how will any electronic component be made without Taiwan? China invading Taiwan is not an NVIDIA risk. It's a whole market risk. In my opinion, if something like that would happen, nearly every tech stock, being the Max 7, will decline dramatically. So I don't believe the TSMC risk should only be put as NVIDIA. If you own Apple, that is a massive risk for you. If you own Microsoft, that is a massive risk for you. If you own Broadcom, that is a massive risk for you. It is not an NVIDIA problem. It is a consumer electronic, and whoever touches the consumer electronic market, and that's a lot of the Max 7. Now, we do have quarter-over-quarter slowdown. NVIDIA's quarter-over-quarter revenue growth slows down to 6% from 12% previous quarters. It's true, but it is important to remember that the China market is not part of this revenue. We can see in the previous one, it was about $5 billion each quarter. So now if you're seeing a slowdown there because of restrictions, obviously you're going to see a slowdown in data center revenue. So just remember to understand that data. And the company also guided for $54 billion in total revenue next quarter, excluding China market. So companies are not going to always be growing at the same rate, but it is important to remember why there might be certain slowdowns. AI GPUs will plateau. I agree. I think there is the possibility that AI GPU spend will plateau, but it's possible. It's possible. The question is when. And right now, the data shows from all these capital expenditures that it is not happening this year. Again, this is more of what if. And I do believe there will be this platform, a plateau, that is the overall over inventory correction. But the data at the moment shows that that is not the case, at least for this year. And right now, at least for next year. Information can change. And that's what's important about investing in tech companies is you need to be able to react with the mass changes that are happening in this industry. Data center is missing by less than 1%, right? Data center numbers missed, and this is the end of their growth story. I do believe right now analysts weren't able to project a true number in data center because there were so many pieces moving around, mainly the China market. But the company still grew quarter over quarter and up 56% year over year. Revenue expectations beat, but the data center market missed by less than 1%. I don't think that's pretty much missing the growth story. We also have the ASIC, right? Is all these big players are developing their own AI chips. I think this is a threat on the top level. But what does data tell us? Google, for example, which is, in my opinion, the best ASIC in the market. They've been doing their own AI chip for the longest, nearly a decade, I believe. And at the moment, they are still dependable on Nvidia. You're going to tell me that someone developing a chip for the 1 year or 2 years is going to eliminate the threat? I don't think that's the case. As long as NVIDIA keeps innovation, this will remain. Again, Google is a beast. They've done it for a long time and are still dependent on NVIDIA GPUs. I mean, if we look at the CPU market is a slower, innovative space. And companies, while they do develop their own CPUs, they still go to AMD and Intel for CPUs regardless. So there's still a need for third-party solutions. Now, the overall question about the two customers, we kind of just go back here. The two customers, three customers, not necessarily a threat. It's because of this. These companies have announced that they only order based on demand. If they're not seeing the demand, they're not ordering it. Right now, enterprises and startups are seeing are requesting AI chips, which is providing a reason for cloud service providers to invest. Margins came in lower than expected. This is another bearish case here. I don't think margins actually came in lower, right? We see margins at 72.2. The company mentioned that because of the Blackwell transformation, they were going to be in the low 70s. Now we're kind of trickling a little bit back up. Company guided for quarter three of 73.5. So it's going to go up from this quarter, and they expect to exit the year with margins in the mid 70s. So continue to grow. So I don't think the margin story is a real threat right now, but I will say that I do think margins will be an early indication of the bear story for Nvidia. So if you are a bear, I think margins is definitely the right place to look at. Why buybacks? This is bearish, right? This company announced $60 billion in buybacks. It seems bubbly. It means that the company is doesn't think the growth is there. So obviously, typically, if you do buybacks, it's because you can't reinvest back in your company and you don't want to. So investors are saying if you're doing $60 billion in buyback, it's because you don't want to invest in growth. It seems bubbly. NVIDIA has a form of problem and a good problem. Free cash flow is $72 billion in the last 12 months. Cash and cash equivalents is about $56 billion. They're building cash so much quicker than they could spend. NVIDIA has that problem. And in theory, you can't really invest $60 billion in growth abilities. You can't throw 60 billions and build manufacturing lines. That's not possible in this ecosystem. They are making software acquisitions. They are investing in their engineering teams. They invest in or partner with manufacturing players. But like I mentioned, you can't just throw $60 billion into this ecosystem. If you believe the market will grow faster for NVIDIA, then buying shares is the smartest use of that capital at the moment. So I don't think this $60 billion in buybacks means any bearish case. Again, it's not like you can throw $60 billion and build more manufacturing plants because TSMC doesn't want to do this. These other players don't want to do this. They want to take their time. They also don't want to overbuild. So they're using the cash because they don't want to sit on cash and it's growing too quickly. Obviously, sitting on cash is probably one of the worst things that they could do. So they're spending it on their shares, which in theory, if they grow faster, looks like the smartest way of capital. hype not higher. Someone saying that this is the highest the hype will go in the AI market. I still believe the hype can still grow. What happened when the robotic hype starts getting stronger? What happens when some amazing medicine is discovered by AI initiatives? The hype can go stronger. What happens when a full movie or a game is made purely with AI? I think hype, unfortunately, can go higher, and this could create kind of an overall fluctuation in stock price. Now, I want to end with this video. No bear case. Someone mentioned it's horrible to not see the blind spots on any stocks. It's not giving good credibility vibes. And I agree. I think it's important to be bearish in a stock. My point is on these bearish thesis, there is data to show otherwise. Now, I believe there is a bearish case. And the biggest bearish case is one that no one talks about: supply chain dependency. Nvidia's products are no longer just one chip. It's a whole freaking system. And any issues, any defects anywhere will slow production. Let's say if their memory players all had some massive defect in their memory side, Nvidia can't produce any more of their chips. That would create a massive bearish case for the AI market. So supply chain dependency is crucial, right? Nvidia is no longer just purely dependent on itself. It's dependent on the server makers. It's dependent on the power solutions. It's dependent on the power infrastructure. It's dependent on the memory side. It's dependent on the cloud service providers being smart enough to build up this AI infrastructure. Supply chain dependency, in my opinion, is the biggest bearish case. Now, I also do agree with certain of the discussions meant to here. I agree that there is the potential competition, especially if NVIDIA stops innovating. And that competition is AMD and big techs developing their own ASIC chips. I also agree that what if slowdown happens? And that is true. If there is a lag of innovation in AI technology, the what if in slowdown is very possible. The only thing I would say is for number 2 and number 3, we have data at the moment that proves otherwise, but the threat is not zero. So for me, the biggest bearish case is one no one discussed, and is the supply chain dependency. The other ones, while there is some truth to them, I do believe right now the data shows otherwise. Now, that is what's important about data. Data fluctuates over time, and it could be a different story within the next year. And if you did enjoy the episode, make sure to hit the thumbs up and the subscribe button. I'm trying to hit 85. 85 is my new goal. We hit 75. That was my original goal, but let's see if we can do 85. Appreciate it. And again, I don't believe this is a stock that's going to 10x anytime soon. I also don't believe this is a stock that's going to go in a straight line. There's going to be a lot of volatility in Nvidia. But right now, the data shows that there is still growth opportunity. So take care, have a good day, and see you all next time.